By almost every official number, the US economy looks great right now. The stock market keeps hitting record highs. Corporate profit margins just hit an all-time high too, over 15%. GDP is growing. Unemployment is low. Ask an economist to grade this economy using the standard scorecard, and it comes back looking like one of the stronger stretches in years. Ask an ordinary household how they're actually doing, and you get a completely different answer. So why does almost nobody feel like the economy is actually good? Start with the number that explains more than any other right now. In the first quarter of this year, US GDP grew about 2%. Sounds like a normal, healthy quarter. Here's the part that changes everything. Roughly 3/4 of that growth came from one single source: AI-related investment. Data centers, servers, software, not from you buying things, not from restaurants, retail, or everyday household spending. Consumer spending's contribution to growth that quarter nearly vanished. Read that again. The engine that used to power most of the US economy barely moved the needle. A handful of tech companies did almost all the pulling instead. Just 5 companies are behind most of it: Microsoft, Amazon, Google, Meta, and Oracle. Together, they're on track to spend something like $800 billion this year alone, building AI infrastructure. That single number now adds an estimated 2.5 percentage points to US GDP growth by itself. Take that spending away, and the strong economy you keep hearing about looks a lot closer to standing still. There's an odd detail buried inside this spending too. Right now, most of that $800 billion is going toward capacity, not finished products. Land, chips, buildings, power. The output isn't a service you can buy yet. It's the ability to eventually produce one. Economists have compared it to the railroads and canals of an earlier industrial era. Enormous fixed costs, built years ahead of the revenue that's supposed to justify them. Some analysts have started drawing a direct comparison to the dot-com build-out of the late 1990s. Back then, telecom companies laid fiber optic cable at a similarly massive scale, years before the internet. Traffic existed to fill it. AI-related investment is now running at roughly the same share of the economy that cable build-out hit at its peak. Corporate profit margins tell a similar story of concentration. Back in 2019, forward profit margins for the S&P 500 sat around 12%. Today, they've climbed to over 15%, an all-time high. That's not spread evenly across every business in America. It's concentrated heavily in the same handful of companies driving the AI build-out in the first place. So the headline growth is real. It's just coming from a very narrow place. That narrowness shows up somewhere you might not expect. Your own retirement account. If you own an S&P 500 index fund, you probably think of it as broad, diversified exposure to the entire American economy. 500 different companies, spreading out the risk. That's not really true anymore. The top 10 stocks in the S&P 500 now make up roughly 43% of the entire index's value. That's the highest concentration ever recorded, and it's not particularly close. The old benchmark for dangerously concentrated was the dot-com bubble back in 2000. At its peak then, the top 10 stocks made up about 27% of the index. Today's number blows past that. In one recent stretch this spring, just 10 stocks drove 69% of the entire index's gains. The other 490 companies were, in the words of one analyst, largely just along for the ride. Here's the part that should actually concern anyone with a retirement account. Weight and earnings aren't moving together anymore either. The top 10 stocks account for about 41% of the index's total value, but only around 32% of its actual earnings. That gap has been widening for a decade. How much of the market these companies represent versus how much profit they're actually generating. Market value is running ahead of the fundamentals that are supposed to justify it. So even the boring, safe version of investing has changed. A broad index fund has quietly turned into a concentrated bet on a handful of AI-linked companies, whether the person holding it realizes that or not. Now, the winners in this story aren't only stock owners. There's a second group benefiting too, and it's worth naming because it complicates the picture in an interesting way. Electricians working on data center construction sites. Some of the youngest ones in hot markets like Texas are reportedly earning between $240,000 and $280,000 a year with no college debt. Construction workers on data center projects earn about $82,000 a year on average, roughly 32% more than workers on standard commercial builds. Demand for HVAC engineers, robotics technicians, and skilled trades broadly has surged since 2022, in some categories by well over 100%. NVIDIA's own CEO has called this the largest infrastructure build-out in human history, one he expects to create genuine jobs for electricians, plumbers, and steel workers, not just software engineers. That's a real physical blue-collar income boost flowing directly out of the same AI spending driving the stock market. But notice the shape of it. It's concentrated in specific trades, specific skills, specific metro areas near active construction sites. It's not a broad wage increase across the economy. It's another narrow beneficiary group, just a different one than Wall Street. Meanwhile, the white-collar workers at some of those very companies are being laid off in the same period, as those companies cut costs elsewhere specifically to help fund the build-out. Two very different labor markets inside the same AI boom, moving in opposite directions at the same time. Now, here's the question that actually matters more than any of this. Who benefits when that spending turns into stock market gains? The Federal Reserve tracks this precisely, and the answer isn't close. The wealthiest 10% of Americans now own somewhere around 90% of all stocks in the country. The bottom half of American households own about 1%. So when the stock market hits a new record, it's not really the economy celebrating. It's a specific slice of it. That slice just added roughly $5 trillion in wealth in a single recent quarter. The top 10% overall are now sitting on more than $113 trillion, up over $40 trillion since 2020 alone. Economists have a name for what happens next: the wealth effect. When your portfolio grows, you feel richer even before you sell a single share. Feeling richer changes behavior. More vacations, more dining out, more big-ticket purchases. That extra spending shows up in the exact same consumer spending numbers used to judge how the economy is doing. Except it's not really the whole economy spending more. It's a fairly narrow slice of it, spending on behalf of gains most other households never received. Meanwhile, the bottom half of the country holds most of its wealth in something completely different: their homes, not stock portfolios, which means when AI stocks rally, one group gets dramatically richer. The other group barely notices because they were never holding the asset that just went up. Picture two households, both watching the same market rally on the news. One checks a brokerage app, sees a number climb, and mentally books next year's vacation. The other doesn't own a single share directly or through a retirement account. For that household, the record-breaking headline is just background noise, describing a party they weren't invited to. So if AI investment is propping up growth and stock gains are propping up wealth for the top, what's actually happening to everyone else? They're getting squeezed from the other direction entirely. This divide has a geography to it too, not just at income level. Data center investment is landing overwhelmingly in a handful of states: Texas, Virginia, Ohio, Arizona, places with cheap land, available power, and friendly permitting. Those regions are seeing real, measurable economic activity, construction jobs, new tax revenue, growing local economies tied directly to the build out. Most other parts of the country aren't seeing any of that investment directly. They're only seeing the downstream effects. Higher electricity prices as utilities pass along the cost of new grid capacity, higher insurance premiums tied to broader national trends, not local ones, the same national inflation numbers without the local construction boom that's helping offset them in places like Texas. So even geographically, this isn't one economy having one experience. It's a small number of specific places absorbing the investment while the costs spread out across everywhere else. A data center outside Austin creates real jobs, real tax revenue, and a genuinely stronger local economy. A family in Ohio or Georgia or Pennsylvania has no data center anywhere nearby. They still pay the same higher insurance premiums, the same higher grocery bills, and increasingly a share of the same higher electricity costs as regional grids strain to keep up with demand concentrated somewhere else entirely. Home prices sit near record levels. Mortgage rates are still stuck well above where they sat a few years ago. There's a specific mechanism making this worse, not just bad luck. Millions of homeowners locked in mortgage rates near 3% back when borrowing was cheap. Selling now means giving that rate up and taking on a new loan at double the interest even for the exact same house. So most of them simply aren't selling. That's frozen the supply of homes coming onto the market, which keeps prices elevated even as fewer people can actually afford to buy. Existing home sales recently hit their lowest level relative to the size of the workforce ever recorded. Not because demand disappeared, because the math for both buyers and sellers stopped working at the exact same time for different reasons. Insurance costs, auto, home, health, have all climbed sharply since 2020, in some cases over 60%. Energy prices have spiked too, tied partly to conflict overseas disrupting oil supply. None of these costs show up as a line item on a GDP report, but they show up on every single household's monthly budget without fail. None of these costs are tied to AI spending directly. Some trace back to a war overseas disrupting oil supply. Some trace back to insurers repricing risk after a run of costly years. Different causes, same effect. A squeeze that shows up nowhere in a GDP report and everywhere in a checking account. So you get this strange split. The macro numbers, GDP, the stock market, corporate earnings all point up. The numbers that actually describe daily life, wages after inflation, housing costs, insurance bills, all point the other way. Economists have started calling this the K-shaped economy. One arm of the ladder climbing, the other arm falling. Both arms get blended together into the same national statistics. GDP doesn't distinguish between a hyperscaler building a data center and a family buying groceries. It just adds them together into one number. A number that ends up technically true and almost completely unrepresentative at the exact same time. That gap shows up clearly in how people actually feel. This isn't actually a new flaw in GDP either. It's an old one, just more visible right now than usual. GDP was designed decades ago to measure the total size of economic activity. It was never designed to measure how that activity gets distributed. A country can grow rapidly while most of its citizens see almost none of the benefit. GDP will still report a strong number because, strictly speaking, it's not lying. It's just answering a narrower question than the one most people assume it's answering. Economists have proposed alternative measures for decades, ones that try to capture median household experience rather than total output. None of them have replaced GDP as the headline number because GDP is simple, standardized, and easy to compare across time. That simplicity is also exactly why it can look strong, while so many people feel the opposite. Consumer sentiment has been sitting near some of its lowest readings in decades, lower than several past recessions. Even though this moment, by the official numbers, isn't nearly as severe as any of them. The disconnect itself has become the story. There's also a fragility hiding underneath all of this, worth naming directly. When 3/4 of your growth depends on continued spending by roughly 5 companies, the math gets fragile fast. That growth is only as durable as their willingness to keep spending. If any of those companies pulled back sharply, the strong GDP number wouldn't just soften, it could reverse hard, fast, with very little cushion underneath it. Economists tracking this closely have set up a simple test. If spending outside of AI doesn't start carrying more of the load soon, the entire growth story keeps resting on a single, narrow engine, one that nobody, including the companies running it, has fully guaranteed will keep accelerating forever. Think about what that actually means for something as ordinary as a 401k statement. Millions of Americans check a retirement balance, see it climbing, and reasonably conclude things are going well. That balance is now more tied than ever to the fortunes of roughly 10 companies, all making similar bets on the same technology at the same time. A genuinely diversified portfolio barely exists inside the index itself anymore. Even the kind people were promised when they were told to just buy an index fund. Some fund managers have started steering clients elsewhere, toward equal weight alternatives, which give all 500 companies the same allocation instead of letting the giants dominate. That's a defensive move, not a routine one. It only makes sense if you're worried the current setup is more fragile than it looks. There's one more piece of this that ties everything together, and it's the piece that decides what happens next: the Federal Reserve's job. The Fed sets interest rates by looking at the economy as a whole. Inflation, employment, growth, all blended into national averages. But the growth part of that picture is really just AI capex, and the inflation part is really just energy and insurance costs, squeezing ordinary households. The Fed is left steering with a dashboard that doesn't cleanly separate either story. Cut rates to help struggling households with debt, and you risk pouring more fuel on an already overheated AI investment cycle. Hold rates high to cool that investment cycle down, and you risk tightening the squeeze on households already struggling with borrowing costs. There isn't a clean setting on the dial that helps one side without affecting the other. That's not a hypothetical dilemma. It's the actual situation policymakers are sitting in right now, with no obvious way to thread it perfectly. This isn't even the first time the US economy has looked like this, split sharply between a booming asset class and a struggling everyday economy. Something similar happened in the run-up to 2000 when internet and telecom stocks soared while wage growth for most workers stayed muted. It happened again in the mid-2000s when housing wealth surged for homeowners while renters and lower-income households fell further behind. Both of those periods ended the same way. Not gently. That doesn't mean this one has to end the same way. But the pattern itself is not a new invention. Concentrated gains at the top, funded by narrow, fast-growing investment, layered on top of rising costs for everyone else. It's a shape the US economy has taken before. Now, to be fair, there's a real argument on the other side of this too. Unlike the dot-com era, the companies driving this concentration are not empty shells with no revenue. Nvidia, Microsoft, and Alphabet are among the most profitable companies in human history, generating enormous real cash flow even after all this spending. Cloud revenue at the major hyperscalers is still growing by double digits, driven by real paying customers today, not speculative future demand. That's a meaningful difference from the dot-com era. Back in 1999, plenty of companies had a business plan and a stock ticker, but nothing resembling actual revenue. Some economists argue for patience here. If AI genuinely delivers the productivity gains it promises over the next decade, narrow spending today could translate into much broader gains later, the same way earlier infrastructure booms eventually did. Highways, electricity, and the internet itself all started as concentrated, expensive build-outs before they became something everyone benefited from. Nobody, decades later, complained that early telephone infrastructure was too concentrated, even though a handful of companies built it first. That's a real possibility, not a fantasy. But it's a bet on the future, not a description of the present. Bets on the future have been wrong before, and they've been right before too. Right now, today, the gains are narrow. The costs of everyday life are broad. And nothing about that combination is guaranteed to resolve itself just because the underlying technology eventually works as promised. So here's the honest way to think about all of this. The economy didn't secretly collapse while the headlines said otherwise. It didn't fake its way to record stock prices. What actually changed is narrower and in some ways stranger. Growth increasingly comes from a small number of companies spending enormous amounts of money on a technology most households don't directly touch. The gains from that spending flow overwhelmingly to people who already owned assets before it started. And the costs of everyday life keep climbing regardless, showing up in a completely different set of numbers that most GDP headlines never mention. None of this means the AI build-out is fake, or that it won't eventually matter for everyone. It's entirely possible this follows the same arc as those earlier build-outs, given enough time, but eventually is doing a lot of work in that sentence. Right now, this year, the gap between the headline numbers and the household experience is not shrinking. It's widening, and it's widening fast enough that both sides of it are becoming harder to ignore. Policymakers keep pointing to GDP and the stock market as evidence the economy is fundamentally sound. Ordinary households keep pointing to their own bank statements as evidence it very much isn't. Both are technically describing the same economy. They're just describing completely different parts of it. The economy isn't broken. It's just increasingly a good economy for a specific group of people, running alongside a much harder one for everyone else. Both measured with the exact same ruler. That ruler was built to measure size. It was never built to measure who the growth is actually for. Until that changes, two things can both stay true at the exact same time. The economy is strong, and the economy feels terrible, both describing the exact same set of numbers.